Hello my fellow freedom builders and welcome back to the channel. Yesterday we had the FOMC meeting where Fed is giving their interest rates and their take on the future, and I just thought I would give a quick comment on that. First of all, if you haven't noticed, Fed hiked the rate by 25 basis points, meaning 1/4%. We can see this here. The current target right now is 4.75 to 5%. And well, right now, when we're looking forward, and I will give a brief summary of the meeting and the press conference in a second, have a look at the markets as well. However, I just wanted to have a quick look here at the FOMC countdown. We can see there's 40 days left to the next meeting. So this is a good page to visit once in a while. Right now we can see that the market is pricing in. This is not a poll. This is not someone thinking this. This is from the futures market, where we can see what sort of insurances and products are the market buying and selling. And right now we can see that the market is pricing in around a 50-50 chance as to what the Fed will do next time. Right now, as we can see, 4.75 to 5%. So there's a 51% chance or probability that that will stay the same next time. There is about the same in probability that they will hike to up to 5%. Now that is interesting. It can change with the speed of lightning. You can see here a month ago that was completely different numbers. We've had a little banking crisis. In the meantime, if we go out to the 14th of June, we can see that there is actually priced in a 16.5% chance or probability of a rate cut of 1/4%. That would be a surprise, I would say, but that is what the market is pricing in right now. When we go to the July meeting, we can see that there's actually almost a 15% probability of 2 cuts. And we can see that there's a majority of the participants, or it is priced in as such, that there will be a rate cut of either 1 or 2 times 25 basis points. And when we go further out, we can see that not many in the market believe that they can keep the interest rate at this level. In the November meeting, it's basically unbelievable for the market to have a 5% interest rate. That is interesting, because when we look at the dot plot, and the dot plot is where we can see the participants in the Federal Reserve, what they think will be the end interest rate here in 2023. And they do not agree with the market. When we can see there is the majority of the members are thinking that just above 5%, I think it's 5.1 or something like that, there's the average here. But there are members saying up to almost 6%, and there are some saying one saying down to 4.25 here. When we're looking at the end of 24, that average drops. So if the Fed members actually think that the interest rate will go down to around 4%, then around 3%, and then around 2.75 here. The spread of the Fed members, I think, is something to take notice of, because having the Fed members, and these are the members that basically know most of what is going on in the economy. Not all, but they are at the end of 24 guessing of somewhere between 3% and over 5.5%. That is an insane spread we can see here, but that just tells us a bit about the confusing situation we are in right now, when no one really knows what is going to happen. So that was it. I just wanted to give you a quick briefing, and I was just searching around. I had taken a lot of notes, but then I went into Barron's here, barrons.com. And I can see they actually have the highlights here, and that is basically the same as I noted down. So let's just take it from their highlights here. First of all, Fed's lifts rate by 1/4 point. Nothing new there. That was what I had expected, and of course that's easy to say afterwards, but I have been saying that in several videos and on my Facebook site and to my customers. The reason for me guessing on 25 basis point was that with the latest bank disturbance, the turmoil, the collapse in SVB Bank and First Republic Bank and so on, I simply didn't believe that Fed would dare to hike the 50 basis points. That would be a signal that we are simply determined to destroy the banks and the economy completely. Also, they have been saying once, over and over and over again, they have been saying, we will do anything to kill inflation, anything at all, no matter the cost. So they didn't dare just leaving it at 0% hike, because that would show that they were scared of the situation. So 25 basis point was basically in the middle. It was a safe space. And then next time, well, we can come to that in a second, but Powell basically said that it was not certain we'll have a rate hike next time. Central bank hints in statement that the end of hikes is near. What Powell said was that there were no automated process in line simply to just hike rates by automatic procedure. And that left people thinking that they would probably keep the interest rate at the current level at the next meeting. But it also left the door open for them to hike once or twice again later this year. But that will be quite data dependent. So if we all of a sudden start seeing rising inflation or whatever, a very strong job market and so on, we probably will see one or two hikes again this year. Then Powell said that he was confident in the banking system. Well, just ask yourself, could he say something else? Could he say, I have completely lost confidence in the banking system, I think it's all going to collapse? No, of course he couldn't say that. However, I actually tend to agree with his confidence. And I know that many of the YouTubers out on the internet will disagree with me. I can see tons and tons of YouTubers saying that the banks are going to collapse, all of them. It's all going in the drain, and people are just flushing the banking system out the toilet. That is not what's going to happen. And people that are saying that, in my opinion, are not completely aware of the regulations that were put in place after the last financial crisis in 2007 to 9. Because at that point, the politicians, the Fed and so on, were so scared that this would happen again that they put some very strict regulations on the banking system. Now, that was good. They put some very, very strict regulations on banks that had a balance sheet over $50 billion. Now, then came a president that thought it was better to please the entire business world. So the bank lobbied hard to the politicians, and that meant that they lifted the regulations, which was a shame. That means that these tough regulations only were accounted for banks over 250 billion on the balance sheet, meaning that all the SVB Bank, First Republic and so on got a lot of room to move in and to take some huge risks in. And they have, SVB, that is proven, they have deliberately kept their balance sheet just shy of 250, something like $249.8 billion, simply to not get into this regulation show. So what Janet Yellen is out saying now is that you can probably expect some more regulations, and I think that is a good thing if you ask me. Then there's a point here, but stop short of saying he'd do whatever it takes to save depositors. He was actually asked, and that is an interesting thing here. He was asked if they were going to make what is called a blanket guarantee for the banking sector. And he said no. And Janet Yellen basically said the same in a statement earlier. And I want to show you the price movement of this statement, because if we're going in here looking at the S&P 500, now this is on a daily chart, but let's just broaden it out a bit and have a look at the 15-minute chart here, meaning that every single of these candles are now 15 minutes. What we can see here is that, let's just get the timing right, I can put a marker on here, the time we got the interest rate was here. Then 15 minutes later, here, Powell started speaking. Let me see if I can put it in here. Maybe we should go down even to a 5-minute chart, just to show you the effect here. Now, around here, Powell started speaking, and people were actually pleased with what he said. But then he was asked if they were going to give a blanket guarantee to the banks, meaning that the Fed and the government would give a guarantee for the entire banking system for every single deposit in the banks. And I would say, of course not. There are $19 trillion deposited in US banks right now, and they will not be pulled all at once. So why would they have to tie up $19 trillion in a blanket guarantee? That is insane. And if people are getting less confident with one bank, let's say it was SVB Bank before the crash, and a business have $50 million in there, if they pull them out and have a bank run on the SVB Bank, do you think they will take out the cash and put in a safe in the office space, or put down under the mattress or something like that? No, of course not. They will put the money into another bank that they are more confident will survive. So giving a complete $19 trillion blanket guarantee is absolutely insane. No one in their right mind believed that that would happen. However, the market reacted differently, because Powell was speaking here, and then all of a sudden he got asked this question about the banks, and the market started dropping. Also, the statement from Yellen started to circulate around here, so the market really dropped. I left my computer for 20 minutes or so at this point, because I've heard what I wanted to hear from Powell. I thought so anyway. So when I got back, the market had just plummeted completely, and I was a bit surprised because I hadn't seen that coming. But that is, as far as I can tell, simply because of them saying, no, we are basically not giving one broad guarantee that'll cover every single bank. However, when the market overnight here and the futures market start to chew a bit on this statement, I think they figured out, well, who actually thought they would, and would it make sense to do that? And no, it wouldn't. So I think the market will quickly recuperate after this and just get up again. It is hard to say how much and how quickly, but looking at my statistical indicator here, that started to say that the buyers or the investors should starting looking for excuses to buy here some weeks ago, and then we've had some turmoil with the banks, but basically the market hasn't collapsed completely. And that shows me that this error here shows me there's a high likelihood of investors trying to buy the dip, and I actually think that's what we are seeing right now. We can see the Nasdaq as well is actually the other day was up on a daily basis, though, up making the new a new high here, the highest close since sometimes in August, September last year. So that was a bit comforting. Anyway, just to get back to the highlights here. He stopped off saying he would do whatever it took for the depositors, so they will cover them. There's no doubt in my mind. The weekend where SVB had got in trouble on Friday, I went out saying in the weekend, just give them a day or so during the weekend. Fed will definitely come out saying we will cover every depositor in the SVB bank, and they did, because it was the right thing to do. So anyway, I will. My opinion is, and that is a humble opinion, and it can be wrong, but I think that for now at least the banks are safe. If we can get through 1 week, maybe two, without a new bank getting into trouble, like Credit Suisse in Switzerland, like SVB, like First Republic, Silvergate before that, there was a bit more crypto related, then I think the market will go into risk on again. So basically that was the highlights of the night here. Another thing I just want to comment on is the Fed's balance sheet. I have seen a lot of worried statements about this hike here. Let's just zoom in a bit. This is the Fed's balance sheet, meaning how many bonds and so on they have on the balance sheet. And they have been doing what is called a quantitative tightening, meaning they have sold out, they have accepted less and less debt or the bonds on their balance sheet. Now, if we go back, look at the historics here, we can see that it all started back after the financial crisis, really got some speed here, some momentum up in 13, 14, and then it leveled out in 15, 16 and started to level off in the end of 17, beginning of 18. That basically led to the 20% crash in the market in Q4 in 2018. And at that point, there was a president that had said that basically the barometer for his success was the stock market. So he could not really live with the plummeting stock market. So therefore, he pushed Powell quite hard and threatened with putting another chair of the Fed in if Powell didn't want to start doing quantitative easing again. So that was what they did. They started to lowering the interest rate, which in my opinion was completely stupid. And then of course came the 2020 scenario with a lot of money injected into the economy. And now we can see they have actually tightened. Now, then we get something like this. They have tightened for several months, and now in less than a week or so, they start easing up with $300 billion. And people are worried about this and said this will lead to new higher inflation. In my opinion, it won't. And of course, I'm not a banker, I'm not an economist, but in my opinion, this is not money flowing directly out to the users, to the consumers. If we're looking at these quantitative easing program, that was simply stimulus checks and money being pumped directly out to the consumers, which led to an insane inflation, and that was easy to predict. The whole transitory story is completely bollocks. However, what is happening here is simply that they are taking over, or they're guaranteeing for some of the bonds that the banks have bought. SVB were not really in trouble. Well, they were, because the cash deposits they have gotten from the customer, they have put into some 3, 4, 5 year bonds to get a higher yield, which meant that when they had a bank run, they couldn't get a hand on their liquidity right away. So what Fed actually did was take over, at least on paper, some of these bonds, so that SVB and the other banks were certain that there were liquidity enough for the customers. But this is not really money that is pumped out to the consumers. This is to make sure that if someone wants their money from the banks, it is possible for them to get it. So I see this as a temporary thing. I know that's a dangerous thing to say, because all of these have basically been temporary. But this is not really something I personally am worried about. I'm more worried about, well, not worried because it is the right thing, but for the stock market, it normally results in falling prices when we see quantitative tightening, because there are less money in the system. All right, I think that's it for today. I just want to give a quick update here after the FOMC meeting. And I would have waited until the weekly wrap up tomorrow, but this was more recent, so I think it was the right thing to do today. That's all for now. I will soon get out with some videos about specific stocks, way to analyze it, so on and so forth. But right now there's a lot of economic fundamental stuff, macro stuff going on in the economy, and I thought that was the right thing to get out to you first. That's all for now. Take care of yourself out there, and I'll talk to you again shortly. Bye.